Does a company like Amazon even need an introduction? I mean, the Amazon packages are stacked up on front porches throughout my neighborhood, but what most people don't know is that Amazon Web Services is the real profit driver behind the company. The entire entity reported earnings after the market closed just a few hours ago, and the market was blown away by what it saw, sending shares up by close to 10% after hours. That's $250 billion. What happened during the quarter? Let's spend the next couple of minutes trying to figure this out. My name is Brian Stoffel. At the time of this recording, not only do I own Amazon, it's one of my largest holdings. So this was the second quarter for Amazon. Its market cap tomorrow will be somewhere between 2.5 and 3 trillion with a T dollars. Now remember, this is a huge company growing off a huge base, and yet revenue grew 20%. That was ahead of analyst estimates and ahead of their own internal guidance. Earnings per share came in at $5.75, which was way ahead of estimates, way ahead of what it was out last year, and is absolutely meaningless. I'll get to why in a second. More importantly, management had guided for a midpoint of $22 billion in operating income, and they blew that out of the water with $27.5 billion in operating income. Let's look at margins. Nothing to not like here. Gross margins were expanding, and it continues a multi-decade trend of increases in gross margin. Operating margin was also up meaningfully. That net margin, don't be fooled. It's great, but it's not as good as this looks, and we'll talk about why in just a minute. Now, all that being said, free cash flow went from barely positive to very negative during the quarter. Why? It should be no question. It is the build out of data centers throughout the United States to help meet demand for AI services via AWS. The company pays upfront for all of that and depreciates those investments over time, which is why net income didn't suffer as much. Net income, and this is the clue as to why I've been saying we'll talk about it in a minute, net income basically tripled. Why? Because of an equity investment in Anthropic. That means nothing for the underlying business, so don't read too much into this net income jump. Now, I will say that the balance sheet is now upside down. Not by a ton, but upside down. They do have $123 billion in cash, but they've got $130 billion in debt. This isn't the first time we've seen this. The company did this during the pandemic and showed that they can be just fine because they know they can turn on the free cash flow machine whenever they want, so they're willing to go into debt to do that. Let's go down the income statement, remembering that this uses accrual accounting, which means that if you spend, say, $20,000, $30,000 on a new car that you expect to last 10 years, you only count $3,000 per year. That's the same idea behind the accrual accounting for data centers and the chips that go in them. So, total sales were up 20%, but the cost of those sales were only up 19%. When the cost of sales grows slower than revenue, that's a good thing. That's why it's coded green. But this is the real leverage here. Operating expenses, which do use accrual accounting, so a lot of those investments in technology and infrastructure, those increases are more on a cash basis, but not as much on an accrual basis. Those were only up 14%, and this shows why the company believes it has operating leverage moving forward. Operating income was up 43%. Now, I realize that's not real cash because everything is depreciated, but 43% jump in operating income is meaningful. Now, because of that investment in Anthropic, which you see, it's not the only thing, but other investments added over $50 billion in income, makes this meaningless. It is worth noting the number of shares outstanding was up about 1%. But what else happened during the quarter? Let's head on over to fiscal.ai to find out. So what I pulled up here, are all of Amazon's different revenue streams. Now, this yellow one, that's the one that we all know. That's the company selling things online. This right here are physical stores, mainly Whole Foods. The purple is third-party seller services, and this is fulfillment by Amazon. It is worth noting that Amazon has opened up its entire fulfillment network and allows companies to use Amazon's network to do fulfillment without even listing their products on Amazon. So this could get a boost. This is really a higher, not high, but higher margin business based on the back of all the fulfillment centers that are spread throughout the world. This is subscription services, including Amazon Prime. This right here is AWS. That's very important. And at the bottom, we have advertising services. Now, what I'm going to do is I'm going to put this on the quarterly view so we can get a better look at what's going on with the growth rates at each one of these. There's a couple I want to call out. The first one that I want to call out is online stores. So this is revenue growth for online stores. And what you can see is that it has been accelerating. The revenue from online stores has been accelerating its growth pace from 9% growth just 2 quarters ago to 15% growth right now. That is the core stable part of the business, and it is looking very good. Let's go to third party, which again just opened up to include companies that don't even list on Amazon. Revenue growth there, again, accelerating from 11% 2 quarters ago to 16% this quarter. Let's go to advertising. This is an incredibly high margin business for Amazon. And as you might expect, if online stores revenue is accelerating, then more people are probably going to Amazon's website and they're looking at things. And when they're looking at those things, they're going to see more ads. So the advertising business also is increasing from 23% growth 2 quarters ago to now 26% growth. Again, very high margin business. And finally, I saved this one for last very much on purpose, is AWS, Amazon Web Services. Now, what I want to show you here, again, that is the red part right here. It might not be the biggest part of revenue, but it is a huge part of profitability. If we go back to the spring of last year, 2025, AWS was growing at 17%. The next quarter, still 17%, then 20%, then 23%, then 28%, until this quarter where it grew 37%. We have seen this with Microsoft and Google. We are seeing an inflection, a serious inflection. The stories out there about supply being nowhere close to meeting demand is true. And it is clear that this build out is worth it, at least in terms of grabbing revenue. The question then becomes, is it worth it in terms of grabbing profits? Well, for that, what we can do is we can simply look at AWS's operating margins, or earnings before interest and taxes. And look at this. Their operating profit was growing by 10% last fall. It is now growing by 64%. Let me say that again. AWS is growing, AWS in general is growing 37%. Its profits are growing 64%. During the conference call, Andy Jassy, the company's CEO, said that AWS is now roughly a $170 billion annual revenue run rate business. Its chips business is a $25 billion run rate business, and its growth rate is more than 100%. It's triple digits. They said that they will not meet demand in 2026. They will not meet demand in 2027, and demand is impressively high in 2028. He said AWS has the potential in time to be a multi-trillion-dollar company with attractive return on invested capital and free cash flow margins. This should be music to any investor's ears, and we'll see what it does to valuation in just a moment. The other thing that I want to point out is just the margins, the overall margins for AWS. They are expanding. They were at 32% last summer. They have continued to expand, and they are now at roughly 40% operating margins for AWS. So you've got something growing 37% with 40% operating margins. That's a rule of 40 score if you add the revenue growth plus the margins. 40 is what you shoot for. They're close to 80. They're at about 76%. This is clearly a business within a business that is firing on all cylinders. Now, looking forward, you might be a little bit worried about the revenue guidance. Management's calling for 9% growth in the current quarter. Analysts were expecting 13% growth, but management pointed out that last year, Prime Day fell in the third quarter. This year, it fell in the second quarter. That's why revenue was able to grow as fast as it did in the quarter that they just reported. If they were in the same quarter, they said that revenue growth would be 13%. So that normalizes a bit. But look at this. The midpoint of management's guidance for operating income in the third quarter is $24.5 billion. The important thing is that's 41% more than it was last year. And the fact of the matter is the range goes up to $26.5 billion. And I wouldn't be surprised to see it come in at $27 billion, which means that operating profit will probably be growing at more than 50%. Now, that is accrual accounting. We are investing, we being Amazon and shareholders, are investing in AWS, the data centers, their Trainium and Gravitas chips, all of those things now for profits later. But accrual accounting lets us get some visibility into what that might look like, and it looks pretty good. So as I said, Amazon, one of my largest positions. What am I going to watch moving forward? Well, number one is any guidance on capital expenditures. Not so much for Amazon, but more for the whole AI trade altogether. Number two are the three, in my opinion, most important business lines in their commerce division, which is online sales, third-party fulfillment, and advertising. Number three, AWS growth and their EBIT, their profit margins. Going to be looking at that. And finally, any new revenue lines like healthcare, like Amazon Leo, things like that, that might help juice returns moving forward. Of course, the big question is, what does all this news do for Amazon's profit margins and their valuation? Well, I'll get to that in a minute. But I have been buying up shares of Amazon over the past year when it was below $200. And members of Stock Investing Mentor, my investing educational program, knew all about that at the time that it happened. Now, if you've enjoyed this, if you'd like to follow my own portfolio, Stock Investing Mentor is just for you. Comes with 3 pillars. Pillar number 1 is live real-time access to my portfolio with explanations of every move that I make, and this accounts for 90% of my family's real-life net worth. Number 2, access to the antifragile universe, where every stock that I follow and own is rated on an antifragile score and evaluation. Every month I come out with my top 5. I even tell you what are the 3 most important metrics to watch. And then live training every week for 1 hour and 24/7 access to an online investing community. And it doesn't stop there. If you join Stock Investing Mentor, you also get Stock Simplifier Pro absolutely free. That's a $400 value. So if this interests you, top link in the show notes below will bring you right there to get 10% off Stock Investing Mentor. Now, I said that Stock Simplifier Pro is included for free. Let's go on over to Stock Simplifier Pro. Now, what I'm going to do is I'm going to type in this ticker symbol, which is AMZN. That's Amazon. And what I'm going to do is I'm going to pull up the valuation tab. Because what I want to do is first look at a couple of metrics. Now, if we look at this company on a price to operating cash flow, it's trading at just 16 times operating cash flow, which is pretty reasonable. Now, price to free cash flow, that's not the best thing to look at. Why? Because they're spending so much on their AI build-out. You can see when capital expenditures are super high, free cash flow is not the best thing to look at. But on a price to operating cash flow, 16 times trailing operating cash flow is pretty reasonable. But let's even look at a reverse discounted cash flow analysis. Now, this doesn't make any sense right now because Amazon doesn't have positive free cash flow, and that makes sense because they're building all the data centers. They're making the investments now to reap the rewards later. But based on the fact that Andy Jassy said that this could be a multi-trillion-dollar business with attractive free cash flow margins and return on invested capital, if we blend everything together, I'm comfortable giving this company an optimized free cash flow margin of 15%. Now, right now, they've got zero in free cash flow, more or less. I'm rounding. But if we optimize it, they could have free cash flow in the range of $115 billion. I believe that Amazon has an incredibly wide moat, so I'm willing to give them a 3%, let's call it 2.5% terminal growth rate. Okay? Now, how much is Amazon expected to grow moving forward? We can actually find that out if we just go to the income statement. We put this on an annual view, and what we want to do is just look at revenue growth over the next 3 years. Now, if I were averaging this out, I would say it's reasonable to expect that Amazon will grow its revenue by about 14% per year. They could definitely surprise to the upside, but let's call it 14% per year over the next 3 years. So if I split this growth and I say over the next 3 years, they're expected to grow about 14%, a 2.5% terminal growth rate, a 10% discount rate, and a 15% free cash flow margin. That means that all Amazon has to do is grow, look at this, 6% per year from year 4 through year 10. I think that is an incredibly reasonable bar, especially considering how fast AWS is growing and all the underlying businesses of advertising, third-party fulfillment, what have you. I think that that is very, very, very reasonable. So I think Amazon looks very attractive today. So that's my take on Amazon's quarter. Let me know what you think in the comments section below. Don't forget to hit subscribe for the next time Amazon reports in 90 days. Until that time, Brian out.